All right, ladies, we're ready to begin.
Deep breath.
Good afternoon or good morning to those joining us today on the West Coast. Welcome to a special webinar on identifying and safeguarding against business fraud presented by Offsite Business Services. My name is Gary Polodna, and I will be monitoring today's program. If you have any questions of our panelists, please type it in the box on the side of your screen, and we'll do our best to answer them at the end of the session. A staggering number of businesses falter and even fail because someone on the inside, an employee, vendor, or even a partner, steals money, goods, data, or intellectual property from the organization. For small businesses, the median loss due to fraud is greater than what has occurred in Fortune 500 companies. In fact, 1/3 of all business bankruptcies are due to employee theft, and American businesses lose 7% of their annual revenues to fraud. Fraud prevention is a key concern of growing companies in today's market. As fraud attacks continue to become more sophisticated, it's more important than ever to stay informed of potential threats. Learning the warning signs can help business owners prevent and detect criminal activity and implement options to avoid future issues. In today's webinar, our panel explains the tools you can use to prevent incidences and address problems if they occur. First, let me introduce today's panel. Kimberly Shannon, President of Offsite Business Services in Orland Park, Illinois. Nancy Smyth, President of Sunburst Software Solutions, located in West Charleston, Vermont. And Shamese Shular, President of SHU Books, with an office in Norwalk, Connecticut, and soon adding an office in the Miami and Fort Lauderdale area. Ladies, thank you for sharing your expertise today. Nancy, let's start with you. What are some of the warning signs a business should look for if they suspect fraud?
Well, there's a lot of things that can go on, especially with people. You want to kind of keep an eye on folks who seem unwilling to share duties or take a vacation. These folks are going to work longer hours than anybody else in your business, and they're going to absolutely refuse to take time off. Because of their constant availability and seeming dedication to the job, business owners often assign them with increasingly important tasks. As a result, they become solely responsible for critical tasks within businesses. And with no one looking over their shoulder, they're free to commit fraud undetected. Another key place is an employee who is overly interested in the personal lives of their coworkers. These folks absolutely love to have their nose in everybody's business and want to be everybody's friend. Sure, this may seem to be a really good thing in your business, but this person could also be the office thief, because their coworkers are going to say, oh, so-and-so would never, you know, she's so kind and considerate and blah, blah, blah. But they very well, they're garnering trust, and in the wrong hands, and only in the wrong hands, this could be a real opportunity for fraud. Perhaps you have an employee who refuses to implement internal controls. This is usually somebody who's got a real dominant or controlling personality, and they have to do everything themselves because nobody can do it as well as they can, or at least they say, but they really just don't want to delegate responsibility in order to hide and extend their fraudulent activities. Another place to look is an employee who wants to...
The broadcast is now starting. All attendees are in listen-only mode.
Ooh. Sorry, that was weird. Perhaps we have an employee who wants to replace existing suppliers with their friends who can do it better for a better price. Those who are maybe living beyond their means, they seem to work excessively. They're always working, but man, their accounting records are an absolute mess. Chronic shortage of cash, you know, the ones that are always crying poverty, need a loan or an advance, or maybe it's people who have had past legal problems or addiction problems. You know, those are our people signs. These signs often transfer into various areas or activities. Again, we're talking, you know, the financial information reported is inconsistent with what the company's doing. Let's say, you know, you're a contractor and, you know, you've got crews out and you're working, and, you know, you're billing out the revenue, but the money coming in seems really inconsistent or not quite on par. Maybe when you review a profit and loss, you're looking at abnormally high or increased costs in a specific cost center. Again, the dubious record keeping, high overheads. Maybe the bank reconciliations aren't up to date or they're not performed regularly. You know, maybe they haven't been updated in like 3 or 4 months. Small cash discrepancies over a period of time. If you're a business that is heavily involved in receiving actual physical cash. And then there, of course, there's payroll frauds. You want to be on the lookout for checks cut outside of a normal payroll process with no withholdings, even dollar amounts. Maybe the checks even have memos like payroll advance, petty cash, reimbursement, bonus, retro pay. And then, of course, the last biggie is inadequate segregation of duties. That person who has tight control over your business and isn't delegating.
So Nancy, why are businesses susceptible to theft and white-collar crime?
Mainly it's a lack of internal controls. You have that one person who has their hands in all the critical pieces of your business. You really need to spread that out. The same person who makes bank deposits shouldn't be the same person who reconciles the bank account. You know, a lot of small businesses only have a few people, sometimes one, wearing all of the hats. You know, or you have employees that are just totally unsupervised. You also find business owners who fail to implement safeguards, such as dividing duties, you know, or the business owner who finally has a bookkeeper and who says, you know, my time is best spent out in the field, and that employee becomes unsupervised. You know, maybe there's a limited accounting staff, or they feel that they don't need an outside accountant to keep an eye or do a monthly or even quarterly review. But the bottom line trouble with small business owners, and I know I've been guilty of it myself, is we all become too trusting of the people that we hire. They're just like family.
Thanks, Nancy. Kim, I'm sure most business owners do their best to hire the most trustworthy employees. Unfortunately, they can't control their behavior. So why do good employees sometimes make bad choices?
Oh, hi, Gary. Hi, everyone. You know, after 20 years in business, I have just encountered all kinds of different ways that people have committed fraud. And of all of them that I've ever seen, there was only one that was ever reported, and that was actually not even a cash fraud thing, but more of an intellectual property thing. And the sad part is that, as you had mentioned before with the, amount of fraud in small businesses, only about 15% of the occupational fraud is ever even reported. And I'll give you a little freebie on a case study up front here, but my father-in-law, he's deceased now, but I mean, he was a classic case of fraud not even being reported. He was in a retail sales, great salesman, trusted, everybody liked him, always a top producer, the top salesman, but his fault was he had a really bad gambling problem. And, back in his day, it was much easier to walk out the door with cash from a register and, not being able to reconcile the deposits until the bank statement came. But, he was caught so many times, but, the employers would let him get away with it, and they would never report it. And as many times as he did it, he never got arrested. But every employer told him and told everybody, he's a good person, and most people are good people, but they just somehow find themselves in a situation that they just don't feel they have any other way out than to commit the crime. So why do they commit theft? They're desperate. They see no other way out of their situation for a lot of reasons. It could be addiction. It could be healthcare costs for aging parents, high medical costs. I mean, those are just a few of the reasons why people do that. And, Nancy covered some of this earlier, but I just wanted to kind of mention some of the common characteristics of people who do this. Generally, they're male between the ages of 31 and 45. The exception to that is generally a bookkeeper, and they're generally female and older. The bookkeeper is an extremely trusted person in the firm and generally wears multiple hats, and, it's just easy for them to maybe feel that they're in one of those situations, and they start out with, well, I'll just do this once, and they intend to pay the money back, and, they don't get caught, and it happens again and again and again. And, a lot of times, like Nancy said, that the bookkeepers, maybe they start out in a small company, with just maybe the accounts payable, but then after a couple of years, the employer gets busy, their bookkeeper's doing a great job for a lot of reasons, so then he gets less diligent in reviewing the transactions, and maybe after a few years after that, she becomes more trusted. She's the right-hand person. They give her check signing authority, and the employer thinks it's great because it frees up a lot of times. But the downside is, you're really loosening your internal controls. Typically, they also have a college or a postgraduate degree, and the control issues, they're not willing to share duties. They don't take long vacations or don't take their full allotment for several years. They're having financial difficulties or living beyond their means, an addiction problem, and, guarded and unwilling to allow their work papers to be reviewed. And a lot of times, they're first-time offenders. They've never done it before. But this will bring me to actually explaining a little more about the fraud triangle on the next slide. Pressure or motivation, it includes financial problems. Maybe someone's lost a job. Maybe they're upside down on their mortgage, addictions, gambling, shopping, alcohol, drugs, or maybe they feel the pressure to show performance or good results at work. Or, I mean, sometimes it's even as simple as they just want the thrill of being able to get away with it. Rationalization, that's when an individual thinks they're justified. Maybe they think they're underpaid. Maybe they were passed over for a promotion. They don't think it was fair, or the rationalization, it's for their family, or, they need it now, but they promise to pay it back. Opportunity. This is the one that the employer has the most control over. You can't control the motivation, you can't control the rationalization, but you can control the opportunity. And believe me, it's much easier for an employer to deter theft than to detect it. On average, it takes about 18 to 24 months for any kind of fraud to be detected. it's created when there's a weakness in the internal controls. You know, the individual thinks they won't get caught, maybe nobody's looking, you know, they're performing the reconciliations, or maybe the owner isn't even taking the time to review the financials.
Thanks, Kim. Let's bring Shamese into the conversation. Shamese, what are some of the emerging risk factors that companies are facing?
Well, more employees are working from home, so it allows for less supervision. When you're in the office, you may have people walking around, able to look at what you're doing, but when you're doing things virtually, there's just a little bit more room to do things your way, not necessarily the way that you were taught. It could be a couple of shortcuts. There's also online banking, where people have the authority to set up bills, they can do transfers from one account to the other, and that could cause some issues with fraud, setting up fraudulent payees. And that could create identity theft too, because if they have access to, say, merchant accounts and they have client credit card numbers, there could be fraudulent charges going on for fake sales. There's debit cards. If there's company credit cards, the employees could have one for themselves that all link to the same account. They could be making up charges for things that they're purchasing for themselves but make it look like it's for the company. And there's also check fraud. If they have check signing authority, they may take a couple checks home, or they may say that certain things are voided in the system and those checks are actually clearing later. So those are some of the emerging risk factors.
What about typical scams and schemes?
Some of the typical scams and schemes that I'm going to talk about, most of them apply to companies that have inventory or warehouses, but fraud happens everywhere. So just keep some of the things in mind that I'm going to discuss when I talk about non-cash theft, credit card fraud, and business-to-business fraud. Non-cash theft includes unconcealed larceny, falsifying shipping and receiving reports, fraudulent shipments, and fraudulent write-offs. And we're going to get into a little bit more depth on the next slides. Unconcealed larceny means that employees steal property of the company and make no attempt to cover it up. Some examples of this could be items that are coming in by shipments, but they're writing them off as damaged. They are saying that some of the items were never received. They're taking merchandise from outgoing shipments. This could also be done for employees that have keys to the warehouse. They could be coming in after hours and taking things and then reselling it later. This isn't reported because co-workers trust each other and they think that there must be a pretty good reason for someone to put themselves at risk. Co-workers don't want to get involved. They don't want to risk losing their jobs, especially if a superior is committing the theft. And then sometimes co-workers themselves are involved in the theft and they're definitely not going to tell on themselves. Falsifying receiving and shipping reports. Some of the ways that this is done is, again, recording a shortage or defective goods. Of course, this can cause an issue with the vendor who may bill the company for, say, 1,000 pieces, but the receiver will then argue that only 900 was received. In the end, most of the times, if there's a good relationship, the vendor is just going to credit them and say they don't have to pay for the extra 100 that's missing. The vendor loses money and the receiver unknowingly gains. There could also be the fraudulent shipping reports where another issue is caused between the vendor and receiver, where say you're the vendor now, you're sending out 1,000 pieces, and now the receiver is saying they haven't gotten everything that they were expecting. And you can do a hard count of all your inventory and you say, no, absolutely, we sent you what you asked for. However, again, someone's losing money, there's lost items, and there's lost cash. Sometimes people can pretend to ring up a sale, but they end up just giving the items away, especially if they have a friend come in and commit this fraud with them. The friend will come in and grab some things off the shelf. If it's a retail store, they'll pretend to ring it up. The friend walks out, and then they can later sell it. Some companies that are affected are obviously ones with physical inventory, but again, it could be retail. It could even be a simple office. I had an example recently where one of my clients, they hired a new cleaning company, and the first week that the new cleaning company was there, things were missing. The new cleaning company may not have done it, but someone else in the office who knows that there's been a change could take that opportunity to do something where it might automatically seem that such and such was doing it because it just makes sense. Another piece is there could be fraudulent write-offs. There's forced reconciliation of accounts. When the items are stolen, the thief credits inventory and debits cost of goods to reduce the amount of inventory recorded, and it's all written off to shrunken inventory. There's a way to alter the inventory records. Physical on-hand count is forced to match with the inventory account on the books. Of course, you can have 2, 3, maybe even 5 people going back to check the last person's work, but if they're all in on it together, everything's going to look right. There's, again, fictitious sales orders. False shipments are made less obvious if shipments are sent to a friend who, if someone by chance calls that person to say if they've received something as a double check, they're going to say yes. The theft is finalized by writing off the stolen inventory, writing off bogus receivables to discounts and allowances, or charging the sale to an overdue accounts receivable that will soon be written off. The last one is writing off good inventory, where you're just simply writing off inventory as scrap and then being permitted to take it because the store thinks it's not going to be sold anyway. Take it out and you can resell it for cash. Another thing is credit card fraud. Some typical schemes include de-embossing and re-embossing. You can use heat from any iron at home and the pressure to flatten the card, then applying new names and numbers on this card. Fraudulent advance payments or overpayments can be done, where nowadays credit card companies are required to credit accounts upon receipt of payment. So fraudsters can send in bad checks as payments and then use the available window to make some more bad charges before the check clears and they have noticed that it's been returned. Some typical schemes of identity theft with credit cards is a scam called skimming. These are credit card reading devices sold in electronic stores. Fraudsters can get a hold of the credit card information from one magnetic strip and transfer it to another. Someone is called by phone. The victim is asked to verify their credit card number as a verification to get a special discount. Fraudster could pretend to be calling from MasterCard or Visa, claiming the card may be compromised, and then they'll ask the victim to verify their credit card number. Another example is travel agency scams, where they'll call someone and claim the victim won a discounted trip and ask for credit card information. And they'll run all these charges and they'll never hear again about this so-called trip. Last one is business-to-business scams. This includes telemarketing, internet service, supply scams, and buyer's club. And the telemarketing is when businesses are calling other businesses to claim that they will advertise the company on materials such as notepads, calendars, or other things that are going to be distributed in a local area. They'll provide their information, fill out a fake order form, send the logo and everything, and the money will just be gone and they'll never see their name anywhere on any print. Another one is internet service scams, where people are calling to offer website setup. They're offering to list the company in special directories or internet malls. Another is supply scams, where fraudulent telemarketers will claim to be from an office supply chain that you normally do order your supplies from, but oftentimes the prices are inferior or overpriced, and they're claimed to be offering special deals. Another one is buyer club, where they'll say that they're asking you to become a member of a new club that's going to be going up soon. And these are clubs that don't exist. And for all of these situations, the number one thing that you want to do is just make sure that you get references, look them up online, look at the Better Business Bureau, ask for credit checks, dig deep, get all your information, especially if you have a receptionist answering the phone and you may not be the one taking these calls. You just have to be careful, especially when you're giving out information over the phone.
Sound check.
Double sound check.
Okay, let's try that again. So Nancy, what are some of the simple or inexpensive controls business owners can put into place to discourage fraud?
Well, one of the first things that business owners can do is to make background checks, credit checks, and driving record checks a part of their pre-employment screening. Because believe it or not, about 15% of employees who commit fraud are multiple offenders. So getting this information before you actually hire someone is really a good thing. Segregation of duties, absolute must. The person who handles the actual cash should absolutely not be the same person to create the bank deposit and then take the cash to the bank. Separate mailroom duty from bank deposit duty is another example. Cross-train your employees. Make sure that everybody, make sure that key people know how to do other key functions in your business. A biggie, enforce employee time off. Absolutely no individual should become totally indispensable to a company. Periodic review of accounting records by an outside person or company. That's a biggie. Have a third pair of eyes come in and look at your accounting data and really have them keep an eye on procedures, controls, things that as a business owner we might not look for. Other things are, review your company financial reports. Keep track of your company checks. Purchase and use pre-numbered checks, and periodically do a missing check report. Even in QuickBooks, you can do this. Set up an account on your chart of accounts called voided checks. That's a very simple procedure to implement, and anytime that a check is voided, it needs to be assigned to that account. And the memo field should contain why that check was voided. You know, maybe it was a printer jam, somebody lost a check, etc. As a business owner, if you're dealing with cash, you need to take that money to the bank yourself. Have bank and credit card statements mailed to your home. And really, as a business owner, you should reconcile the bank and the credit card statements yourself every month. Don't just leave it to someone else.
So Nancy, what about controls for people who are QuickBooks users?
Oh, QuickBooks. That's absolutely, there's a lot of things that you can do. The simplest one, as a business owner, when QuickBooks is installed, you should be the administrator, and you should have the administrator account and password. Don't make someone else in your company your QuickBooks company file administrator. Make sure that each person who's going to use QuickBooks has their own user account, permissions, passwords, and if you have a lot of people with their fingers in your books, spring for the enterprise version of QuickBooks where you can get much tighter permissions. You can set up an external accountant user in QuickBooks. You can log in under that account when reconciling the monthly checking or credit card statements. That just adds to the audit trail report in QuickBooks. And if it's always set up that you log into under that external accountant user, you can keep track of things better. Set a closing date at least once a quarter. Again, that's a really easy thing to implement in QuickBooks. Monitor your accounts receivable and accounts payable report. Make sure on your accounts payable report that you know who the vendors are that are showing up there. If you see a name you don't recognize, well, do some investigation. The direct deposit PIN number should only be used by the business owner. I actually have a client whose previous bookkeeper embezzled $80,000 because she was using the direct deposit PIN. Don't upload a signature or a graphic into QuickBooks so that when the checks are printed, they're pre-signed, so to speak. That's an accident looking for a place to happen. Review the audit trail in QuickBooks. That will tell you who's making changes to transactions. Those are a lot of really simple things that you can do that don't cost you a penny. And I know I highly recommend them. Don't give people check signing permissions or implement a policy that checks over a certain amount of money need to have 2 signatures. We're not automatically assuming that every employee that you have on staff is going to be a thief, but on the same hand, we can't really go under the cloud of illusion that everybody is going to be honest. Pay attention to your business.
Thank you, Nancy. Sorry. As someone who's been providing virtual office services for business for over 20 years, can you give us a few examples of what you've seen as business fraud cases?
Sure. Actually, this first one, it's a small business, 2-person office. The bookkeeper had total control over the bill payment. It had even been so long that, she had, I'm using she, I don't want to be, politically incorrect here, but as a general rule, bookkeepers are female. But, she had total control, you know, and the owner traveled frequently, and I mean, she did it all. She received the mail, she entered the bill, she paid the bill, she signed the checks, and she reconciled the bank statement. And, you know, she was able to get away with over $100,000 before she was finally caught. So, you know, clearly she was let go, and, you know, the new bookkeeper had no check signing authority. If the owner travels, you know, he only leaves a few signed checks now, but then he wants them on his desk when he returns so that he can review them and reconcile them and make sure that they're okay. And as Nancy said, you know, the bank and credit card statements are now mailed to the home, where he can review them before the bookkeeper is allowed to reconcile anything. It was a recommendation in this case, but it wasn't actually a solution. But because this individual travels so frequently, there are cloud-based bill payment and even receivable software programs out there that will allow maybe the bookkeeper to enter and upload an actual bill. The owner will be notified, and he can go in and review it and approve it. And then a third party, such as an outside vendor or a different individual, can actually print and mail the check. And all these things can sync directly into QuickBooks, and then it alleviates leaving any kind of signed checks in the office to, you know, it just removes the temptation for that to happen. The second one, you know, was clearly a case of the employer just not looking and checking the deposits against what was in the billing program. And at this point, the billing program wasn't able to sync with the accounting software. So when the employee would receive the payments, it would go into the medical software program, but then when the deposits were deposited into the accounting software, they didn't match the billing program. So a lot of cash was able to be, you know, stolen by the employee, and this was a case where the employee was living well beyond their means and was buying new vehicles and coming in with nice clothes. But the solution was that all copies of all paid receipts in the billing program were printed and matched to the cash deposits daily, so that they could make sure that the cash deposits in the billing program matched the accounting software. And it's really important, especially in nonprofits, I think, that two people need to handle the counting of cash and checks, you know, and that all needs to be reconciled and signed off on prior to making the bank deposits. If the cash or the deposits can't be made that night, it should go into a sealed envelope, and the two people who've handled the counting and putting the information in the check should initial over the seal, so that if the seal's ever broken, that's a clear sign that the deposit's been tampered with. But in this case also, they did go with a different medical billing program that could sync to their accounting software. So that did eliminate a lot of the duplication of efforts and a lot of the extra work that was involved to match the receipts from one program to the deposits in the other. This one actually I just came across not too long ago, but it was a retail shop, and of all of their merchandise theft, they found out that a third of it was committed by the employees, which to me was just staggering. It just seemed, I was just beyond my comprehension that that could happen. And when I talked to the shop owner a little more, you know, employees were bringing in big bags and baggy clothes, and they were small. It was a smaller item, so it was easy for them to smuggle out in this kind of a case. But you know, they did have video surveillance, and they were able to catch the employees that were doing this on video. But in this case, you know, employees were no longer allowed to bring big bags to work to be able to carry these items out in, and employees were not allowed to close to the entrance. And really in any business, if you're in any type of an establishment where employees can walk out with items, all employees should park far away from the entrance. And not only that, I mean, you want your customers to have easy access too, and why should your employees park closer to the entrance? But employees now have to park farther away or not at the back door. That was another issue too, that some of the employees were parking at the back door and just walking out the back door. And then as an employee leaves their shift, all of their bags and any bulky clothes that they wore are checked prior to leaving their store at the end of the shift. And that did really bring down the employee theft from the retail standpoint.
Thanks, Kim. We have a couple questions here from our audience here. First one is, what's a direct deposit PIN?
In QuickBooks, when you set up direct deposit, there's a PIN number that you have to use when you're transferring employee money or employee payroll, and the PIN number is just like the PIN number that you would use to log into your online banking account. Because this woman had access to the direct deposit PIN number, she was giving herself extra money every payday, and that was how she was able to defraud the company. So, make sure that, if you have direct deposit, that you as the business owner actually authorize that direct deposit transmittal and keep that PIN number private.
Okay. Another question. If you require employees to take off, who does their job if they are the only one doing everything, such as one owner, one employee company?
Who wants to answer this?
Well, honestly, I think this is a perfect opportunity for the owner to be able to see what's going on in their books. I mean, not every employee out there is going to commit theft, but I think this is a perfect opportunity for the owner to be opening the mail, looking at the bills that are coming in while the employee's gone. I mean, even if you don't know how to run the accounting software, you can certainly handwrite a check and mail the check out yourself and just keep a copy of it for the bookkeeper to, enter when they come back. And it's also a good opportunity if it's close to the end of a banking billing cycle to reconcile the bank statement yourself. If the books are in order, it shouldn't take you more than, 5 or 10 minutes. And it's a really good check and balance for you to, check out and make sure that everything's in order.
I agree with Kim. It's, just because that key employee is gone for a week doesn't mean that the business stops. Like she said, anybody can handwrite a check to pay a bill, leave the check stub with the vendor invoice, and it can be entered after the fact.
Okay, thank you. Kim, I know you'd also like to address the concern that small businesses have regarding debit versus credit cards.
Yes, I do. Actually, I had the opportunity to listen to Frank Abagnale speak a couple of weeks ago. And for those of you who may not recognize the name, a few years ago there was a movie that came out called Catch Me If You Can that starred Leonardo DiCaprio, who played the character of Frank Abagnale, who committed a lot of check fraud during the late 60s and early 70s and defrauded airlines and hospitals and all kinds of companies for a lot of money. But one of the interesting things that he mentioned is the debit versus credit card issue. And, banks have very limited liability when it comes to any kind of check or debit card fraud. They don't have to give you the money back right away, whereas if you use a credit card for everything, you know, you call your credit card company, you dispute the charge, boom, it's credited back to your account. However, you know, with a debit card, the bank's not going to give you the money back right away. They do not want to be out of that money. So, you know, they're going to investigate it, and that could take several weeks to several months for them to get to the point where they decide whether the debit card is a debit charge is a fraudulent activity or not. So quite frankly, I still think credit card is a better way to go when it comes to business transactions. You know, also if you give a debit card to an employee, there's no way of knowing whether they made the charge or you made the charge. Or, I mean, it's also the case with a credit card, but again, you have a little more leeway with a credit card company than a debit card company.
Okay, are there any other situations that the panelists know of, case study-wise, that could have been a warning sign for business fraud?
I have an interesting one that just came to be this week. In addition to being a pro advisor, I'm also a third-party developer and for QuickBooks. And one of our customers called to reinstate maintenance for one of our software programs. And what happened was, in his company, a husband and wife both worked there. The husband worked out in the field and the wife was the bookkeeper. And she stopped automating a task that previously had been done with software because the software would show that she was padding her husband's payroll. So, you know, if you're a business owner and you've had a piece of software that's automated a critical task in your business and all of a sudden somebody quits using it, you know, that's kind of a flag that, you know, something's wrong. You know, and in this case, you know, somebody took a lot of their time to do something manually in order to hide the fact that they were just padding their husband's paycheck. So that was kind of an interesting little story that I heard in the last week.
Thanks, Nancy. Any other information you'd like to share, maybe specifically regarding check fraud?
Yes, Gary, I do have something. You know, it's hard to think of check fraud as something new as far as, you know, where fraud's concerned, because it seems to have been around for a long time. But, you know, there are some things that I think that business owners need to be aware of, is that you don't even have to order checks from a check company or Intuit or Deluxe or whoever you order checks from anymore. And you can actually buy check stock from an office supply store or a stationery store that's blank, and software is pretty cheap to be able to create these checks. And this actually happened to one of my clients, but someone had actually done this, had bought some check stock, had bought the software. In this case, they didn't use my client's logo, but they went to another company and put another company's logo and their address in the check. And then, you know, it's really easy to get routing information. I mean, you know, a company and say, you know, look, I owe you money, I'm one of your vendors, I'd like to wire you the money. And if maybe somebody doesn't know who this vendor is, they just give out your routing information and your account information. Boom, that goes on the bottom of the check, and, you know, they design a nice, pretty check. And, you know, I mean, banks don't really check signatures anymore. I mean, if they can find a signature, if you happen to have a signature on your website or any other document out there that's publicly out there, these people could even get your signature. And then it's really simple for them to, you know, go to a grocery store or someplace where they claim they're cashing a paycheck and, you know, cash a paycheck and get the cash. And I actually discovered this when I was reconciling the bank statement, which brings us back around to what Nancy said about, you know, regular bank reconciliations. Because again, banks don't have much liability. I mean, they have about 30 days, and then if you don't discover it in 30 days, you're on the hook. The bank isn't going to give you back the money. But there were just a couple of checks when I was reconciling the bank statement for this client that weren't in the QuickBooks file, and that just never happened. And when I went online and checked the image, you know, that's when I had discovered that it was a completely different company up in the name and logo of the check, but it had all of my clients' routing information at the bottom. And they went to a grocery store and said it was a paycheck, and they even had, you know, like pay period from X to X, and cashed 2 checks that way before it was discovered. So, you know, check fraud, you always have to kind of be aware, I think, of the new things that are out there. And I think it's really important for you to always buy check from, you know, Deluxe or Intuit or whoever you use, just to make sure, because they have a lot of things that they put on the checks to make sure that they're legitimate checks, and try to deter fraud in those kinds of instances.
Shamese, I know you have something to add to that as well, too.
Yes, in addition to just being aware of what's out there, it's, you know, Bill.com is a really, really good thing that has come out, especially when it comes to check fraud, because you're basically paying for someone else to take on the risk of, you know, I guess the better way to put it is you're lessening your risk. So you're paying Bill.com to send the checks out on your behalf. It's not coming from your bank per se. When the vendor receives the check, they're not seeing your routing number. They're not seeing your account number. They're seeing something from Bill.com, although it looks like it's coming from you. So another way to just deter that is, you know, people can take these checks and wash them in so many ways, just like Frank Abagnale used to do, and use that information. So if you can get away from that and start taking a look at what is out there to protect your company, you know, just pay $30 a month or so to Bill, and maybe a lot of those things you wouldn't have to worry about anymore because of the approval process there as well. It has to go through a couple of different levels to even say, okay, let's initiate this payment. So there's a lot more control there with the things that are out there these days. And I think a lot of business owners sometimes are afraid to change the way that they're doing business. You know, so many companies are so paper-based, but it's a good thing. So I think if maybe people understood a little bit more, it might be beneficial to their company, especially if they've had check fraud in the past.
Okay, any other thoughts from the panel? Okay, well, I would like to thank everyone who was on the line today for participating. And I'd especially like to thank our 3 panelists, Kim Shannon, Nancy Smyth, and Shamese Shular. Thanks again, everyone, for participating, and have a great day.
Thank you, Gary.
And thanks, Gary. Thanks, everyone.
Thank you.
Are we still here?